Hi, I'm Sandy Weaver with Weaver Financial. Let's do the numbers. In a nutshell, in the fourth quarter, both bonds and stocks raced up. Inflation last month rose a tad from November. It was 3.4% for 2023 compared to 2022's 6.5%, but still above the Federal Reserve System's 2% target. A few signs of a slowing economy are surfacing, yet the labor market remains solid. The Federal Reserve sat pat on short-term interest rates, staying with 5.5%. They indicated that future hikes may be over for this cycle. The response? It was party on. For the year, U.S. large companies rocketed up 26%. Small companies joined in, moving up 17%. Companies overseas added 16%. Yields dropped swiftly on bonds, driving the annual return up to 5.6%. Even though the Federal Reserve indicated they may not raise interest rates anymore, the market pros are expecting more rate cuts in 2024 than the Fed is predicting. Yes, there's a way to measure those expectations. The pivotal point is if inflation drops down into that 2% groove. We're not seeing it yet. Gross domestic product, GDP, grew by 5% in the third quarter. The Atlanta Federal Reserve's estimate is 2.5% for the fourth quarter, so down. GDP for all of 2023 is estimated at 2.5%, but slowing to 1.5% in 2024 as those higher interest rates dig in. Retail sales for the holidays rose a nice 3% from the prior year. The December jobs report said that the economy added a robust number of jobs. Wages increased faster than estimated at 4.1% year over year. The employment rate remained at a full employment low of 3.7%, but those participating in the labor force dropped. These are mostly positive economic indicators, which conflict with some pros' views that we'd slip into recession as the Fed tightened. We may achieve a soft landing yet. Geopolitics are not good. The impact on our economy is not direct, but tensions can worsen. Israel's war with the Hamas in Gaza has already impacted shipping through the Suez Canal. Supply chain problems may increase prices here in the U.S. Russia's war with Ukraine has some concern that we're spending more than is judicious, although it's a tiny percent of our total. Spending on Social Security, Medicare, and Medicaid dwarfs everything. Email me if you'd like an interesting map from NYU Stern School of Business showing geopolitical risk premia by country. The markets react to an event if interest rates or earnings are likely to be impacted. Otherwise, nada. What matters? Two things. Interest rates, which have retreated from last quarter's 5% on the 10-year U.S. Treasury note down to 4%. Businesses no longer enjoy ultra-low interest rates, so making profits is more difficult. Consumers taking out mortgages and loans no longer enjoy low interest rates. That cuts their spending. And two, earnings, which at large companies in the S&P index were a positive 5% in the third quarter and are expected to be positive 2% for the fourth quarter and end the year up a positive 0.5%, 0.5%. Estimates remain at an optimistic 12% for 2024's growth rate. The stock market remains at above average valuations. We just had a year of 0.5% or so earnings growth, and the market has raced upwards. If 2024's robust earnings growth comes to fruition, valuations may normalize, but the market looks ahead. If interest rates move down in 24, that's good for the market. If even more growth by businesses is forecast, another AI innovation, that's good for the market. Can we have a significant pullback? Oh yes. Imagine expanded wars in Europe or the Middle East. Our fractious Congress soon attempts to deal with the budget again. Coordinated cybersecurity attacks that target beyond even our hospitals, and more. Inflation in Europe is still a bit higher than ours, But the central banks there did indeed stop raising short-term interest rates last quarter, as we expected. Economic activity there is not as strong as we'd like. Strong trading partners are important for us. Unemployment is higher there. Overseas stock markets had high returns also, but less exuberant than our U.S. large-cap stock indexes. China is slowly moving into the fast lane again and is expected to finish 2023 with 5% economic growth. Our portfolios remain spread out over bonds and stocks. Bonds finally added to the picture this year. We need those to stabilize and then serve as buffers in bear markets, as in the past. Diversifying is important because any component can suffer a setback or severe downturn. Using different asset classes lets us mitigate a hit from a single component. Betting on just one component and then recovering from a severe loss in it would be a long, steep hill to climb. The math is onerous. For us long-term investors, thoughtful patience with diversification is key. Thank you for your interest. Please call or email if you want to dig in further. I'm glad to pass on my readings, podcasts, and the other sources.